All right, let's get right into it. You know, hitting a goal like saving $15,000, that feels like you've made it, right? It's a huge win. But here's the thing that nobody ever tells you. That is not the finish line. In fact, it's a really critical and honestly kind of dangerous starting point where your very next move is going to determine pretty much everything. And this is really the heart of our entire conversation today. Getting to that number is a huge psychological turning point. The same survival instincts that you use to claw your way to that saving goal can, and often do, flip around and start sabotaging your entire financial future. It's a crazy paradox that traps millions of people. We call this the five-digit trap. It's that exact moment you look at your bank account and for the first time you see a real, meaningful number that isn't attached to debt. And what happens next is a massive psychological shift. Your brain goes from, wow, I can finally save money, to a much, much more dangerous thought. Oh my God, I cannot lose this. And that fear of losing it, well, it leads to one thing: hoarding cash. It feels safe, it feels smart, it feels protective. But this instinct to build a fortress around your new pile of money, it comes with a massive hidden cost. So let's break down exactly why playing it safe is actually a guaranteed way to lose. You know, what's so fascinating here is you're looking at two completely different operating systems for your brain. On one side, you've got survival mode. It's driven by scarcity, and it sees your bank account as a fortress, safety. But the other side, strategic wealth logic, it understands something crucial. Idle cash is always, always losing value to inflation. It's not a gamble to invest. In today's world, it's a necessity. So, what is the actual cost of this fear? Let's put a real number on it. This is the opportunity cost. You could even call it a stupidity tax. It's what happens when you keep just an extra $5,000 sitting idle in a checking account for 30 years, instead of putting it to work in something as simple as an S&P 500 index fund. That one decision, born out of fear, costs you over $80,000. This paralysis, this inaction, it actually has a name: financial constipation. It's when you hoard cash way beyond what you'd need for a normal emergency fund. And yeah, the name is a little gross, but it's perfect because it stops the flow. Money is a form of energy, and when you let it get blocked up, you completely choke off all the opportunities that need that capital to grow. So, okay, how do we fix this blockage? How do we get things moving again? Well, the very first step, we're going to call it step 0. It isn't about finding the next hot stock. It's about plugging the biggest, most damaging leaks in your entire financial foundation. We're talking about eliminating high-interest debt, because doing so offers you a guaranteed return that no market on earth can ever promise. And you have to understand the brutal math of negative compound interest. I mean, think about it. If you have credit card debt at 22% and you're trying to earn, say, 10% in the stock market, you're trying to fill a bucket that has a giant hole in the bottom. You are mathematically guaranteed volunteering to lose money every single day that debt exists. So the action plan here is simple, and it has to be ruthless. Step 1, find any and all debt you have with an interest rate over 7%. Step 2, you attack it with the urgency of a house on fire. Because paying off a 22% interest credit card, that is exactly the same as earning a guaranteed, tax-free 22% return on your money. No investment, not even the safest government bond, can touch that. This is your first and your most important wealth-building move, period. Okay, so once those debt leaks are plugged and your foundation is rock solid, now we can start to build up. But we're not just going to blindly throw money at the market. No, we're going to use a professional framework that institutions use. It's called the capital stack, and it's all about reframing your personal finances like a pro. And this is just a brilliant way to picture it. Instead of seeing your money as one big, messy pile, I want you to start thinking about your portfolio like a skyscraper. Every single floor or every layer of your capital has a totally different job, a different risk level, and a different expectation for returns. All the way from the solid foundation deep in the ground to the speculative penthouse at the very top. Let's break down exactly how this works. At the bottom, the foundation of your skyscraper, we have what's called senior debt. This is your emergency fund, sitting in a high-yield savings account or T-bills. It's the absolute lowest risk. If things go wrong, this layer gets paid first. Then, in the middle, you have the mezzanine layer. This is your broad market index funds, moderate risk for steady, long-term growth. And then, way up at the top, you have your common equity. This is your small, speculative bets. The highest risk for sure, but also the highest potential reward.
And this shows the crucial evolution you have to make. See, when you only have $5,000, your entire stack is that solid foundation. It's 100% senior debt, all defense. But once you cross that $15,000 threshold, your strategy has to change. You've got to start building upwards, shifting that mix to include growth. You have to move from playing pure defense to actually playing some offense.
Now, for another really powerful way to structure this, let's look at something called the barbell strategy. It was made famous by the writer Nassim Taleb, and it's an incredible tool for thriving in a world that is fundamentally uncertain. It's all about combining two extremes. So the core idea here is actually really simple, but it's profound. You put the vast majority of your capital into something hyper safe, and then you put a tiny, tiny portion into something extremely aggressive. You completely avoid that mushy, mediocre middle ground where risks are so often hidden and miscalculated. The whole point is to protect yourself from ever blowing up while giving yourself exposure to massive, life-changing upside. And here's what that looks like in practice. You put, say, 90% of your investable capital into your life jacket, things like cash, T-bills, assets that absolutely cannot go to zero. The other 10%, that goes towards your moonshots. These are your high-risk, high-reward bets that could have explosive growth. Now think about that. What is the absolute most you can possibly lose? 10%. That's it. Your downside is capped, but your potential upside is basically unlimited. This strategy is just so incredibly robust because it allows you to survive literally anything the market throws at you. By capping your losses, you make sure you can never be totally wiped out. And this is the most important part. It keeps you in the game long enough for one of those super rare high-reward opportunities, what Taleb calls a positive black swan, to come along and pay off in a life-changing way. Okay, let's start to bring this all home by really reframing the single biggest theme of this whole explainer. What does financial safety truly mean today? Because it requires a pretty radical shift in how you think about money. And if you take one thing away, please let it be this. That feeling of safety you get from seeing a big number in your checking account, it's an illusion. Real, lasting, durable safety doesn't come from a pile of cash. It comes from building a resilient system, an intelligent, well-designed structure of assets that can handle shocks and at the same time generate growth. And this might be the most challenging part of all. The mindset that got you to $15,000, that incredible saver mindset, is not the one that's going to get you to the next level. In fact, it actually becomes your biggest obstacle. The final, most important step is to consciously evolve your own identity from someone who just saves money to someone who strategically deploys capital. So let's end this with an actionable audit you can do right now. Ask yourself these questions honestly. 1. Is my high-interest debt totally eliminated? That's step 0. 2. Is my lean emergency fund, my foundation, in place? 3. And this is the big one. Have I made that mental shift from hoarding cash to deploying my excess capital? And finally, am I using an intelligent structure like the capital stack or the barbell to do it? This is your checklist for escaping that trap. And that leaves us with one last provocative question I want you to sit with. Take a hard look at your savings. Is that money a bunker that you've built for your fear, a fortress to protect you from the world? Or is it the strong foundation upon which you can start building a future of real growth and opportunity? Ultimately, that choice is yours.